The thing that you have to do before you talk about what is happening now, I think it's probably useful to go back, and you have to really start at the end of the great financial crisis. And the reason is there was a bunch of people coming out of the GFC who confused what the US government and some European governments were doing. At the time, there was the risk of a huge financial contagion. And so the US stepped in and the Federal Reserve started to use their balance sheet to buy toxic assets. And the ECB did that, and I think Japan did that as well. Anyways, a bunch of governments did it. And then there was this body of pseudoscientific economists who coined this thing called modern monetary theory, which basically said, hey, you can keep printing money and introducing it into the economy to smooth things out and to actually drive long-term growth. And it turns out that a bunch of government officials fell for it. And if you fast forward to 2022, so 14 years later, governments around the world had printed something to the tune of about 35 odd trillion dollars of money into the economy that should have never been there. So the thing to remember is, like, we have not necessarily just been obfuscating true supply demand in the last 6 or 8 months when we've been talking about a recession or inflation. We've been actually doing it since 2008. It's just that it's been building up in the system. So one of the things that we have to realize is that all of that money somehow needs to get destroyed in some way, shape, or form if the true economic equilibrium is meant to be found. What is true supply? What is true demand in the absence of government sloshing money around, trying to prop up things that should not be propped up, or buying votes, or all the grifts that these folks have engaged in the last decade and a half have to get undone. So that's the backdrop. So if you think about taking $30 trillion out of the global economy, you're talking about almost, I think it's 85 trillion is the world GDP. So it's almost half of an entire year's worth of global GDP. It's going to take 3 years probably of the slow, meticulous, running off of money, not reintroducing new money. So it seems like we're at the beginning of something that's going to be long and drawn out. And that's separate from whether we're in a recession or not. That's just the bear market that we're in. Right? And so you have to look at asset prices today as a microcosm of a much larger trend that has to be about fake money pushing asset prices up, and now taking all that fake money out and finding out what the real price of something is. And I just don't think that takes 6 months. So for all the people that were, fingers crossed, hoping that this would be the end of it, Fed raises 75, we're done with this, they're going to raise 75 more. I just think that's not how it's probably going to be. It's going to take, 24, 36 months. That may mean the bottom doesn't happen for another 18 months. So I think we're in for a lot of choppy market action. We may not be negotiating against Russia, but we're enabling them to print enormous surpluses. Meaning, I don't know if you guys saw, but there was an article today. Janet Yellen is traveling around basically convincing folks to not include Russian oil from a bunch of import bans so that these Russian oil tankers can be insured. Why? So that they can sell this oil to places like China and India, etc.
The ruble's at a 5-year high.
We push for all these sanctions. Europe gets on board and says, we're going to do it and we're going to take the lumps. And then we go around Europe and basically say, well, we kind of want to fight this proxy war, but at the same time, we want to try to fix inflation, and we didn't mean to cause this. And it's completely disorganized what's happening. Okay. Look, here's the thing. I think we have to also be sensitive to the fact that the Fed operates on a certain class of data. And that data in the 21st century is pretty pathetic. There was an article, I think it was in the New York Times, that really walked through how CPI is calculated. And it's a bunch of people that work for the government that walk around with iPads, building relationships with local businesses in all these random places all around the country, and asking them to, chit-chat for 15 minutes and do these surveys. Now, you would have thought that in 2023 or 2022, what the government would have said to Visa, MasterCard, American Express, all the payment rails, the banks, and Stripe is, send me a feed in the following structured way so that I can actually have an absolute precise sense of inflation, because inflation really only occurs when a good or a service trades hands for money, right? And you calculate what did that thing trade at the day before and what does it trade for today. So you could get an absolute precise sense of it. Instead, we do this random sampling thing. If you read this article, your takeaway will be, oh my God, this is very rickety, and it drives an enormous hammer that we use to try to manage the economy. That's the first thing. I think you need to buckle your seatbelt, because the next 3, 4, 5 months of CPI will probably be very, very bad. 7, 8, 9%. Why? There are a handful of components that have gotten completely run away. Number one, the biggest one is rent. And so rent works on a 3-month lag. We're going to reintroduce what the true owner's equivalent rent is into CPI. So we can already forecast that CPI going up. Russia is basically trying to break the back of Europe by now messing with their nat gas supplies. The German energy minister yesterday said that if that happens, it could be a contagion equivalent to Lehman Brothers with respect to energy. When you play all of these things out, what you have is unfortunately rampant runaway costs that really have no mechanism to get back in check in the absence of some real governmental changes. Our policy on this Ukraine-Russia war, how we intend to sort of work or cooperate or fight with China, all of these things have to get solved. So in the absence of that, prices are going to continue to go up. And so what does the Fed do? How does it throw away what little credibility it has left when there's 8 and 9% inflation prints and saying, we think we're done for right now? You can't do that. So they will overcorrect because there's just going to be so much pressure for them to act. All roads, I think, lead to lower equity prices. We've seen the first wave, but now it has to touch all these other areas. For example, we have gotten totally drunk on debt as a country. One of the most obvious places where we've been serving alcohol far too late into the night is in the financing of all these private equity leverage buyouts. These are sketchy companies that are sort of like teetering on insolvency at times, where private equity comes in, levers up the balance sheet with debt. They price it right to the edge of what's legally allowed or what's financeable, and then they go do it. But that's all assuming the economy continues to grow. And so if all of a sudden you have some recessionary forces or prices go up and earnings don't, you'll have a contagion in the debt markets. You could have a contagion in the commodity market. So we're dealing with some really tough boundary conditions. I do think that we can know these things without sampling in such a porous way. And now, we're going to look, we've had a system of overcorrecting and undercorrecting for years. The problem is the stakes get higher and higher as the economy grows and becomes more complicated and intertwined.
And we have more leverage.
Economies. I also want to tell you guys a quick story. One of the most interesting canaries in the coal mine of all of this was 2 days ago and what happened to Facebook. And this sort of ties a lot of this stuff together in terms of economics, inflation, asset prices, equities. Everybody was saying, oh gosh, the market's going to rip on the open. And then on Tuesday, the market, the S&P was up like 250 basis points, 2.5%. And the NASDAQ was also up, call it maybe 300 basis points, roughly. But Facebook was down like 400 points, right? So it's a big spread. And why is that? And I was like, this makes no sense to me. What is going on with this price action? Everything was up. Apple was up. Google was up. And so I called around and, I was like, why is this happening? And this is the best explanation I got. When you look at who the incremental buyer is in the stock market, it tends to give you a sense of whether prices can go up or will continue to go down. And the poorest informed buyer tends to be retail. And the most informed buyer tends to be these very large institutional hedge funds, right? So there's a spectrum. And Facebook is an example of big tech that is poorly owned by retail. So it's mostly owned by smart money. And the case that smart money makes for owning Facebook is that it's got an extremely cheap price to earnings ratio. So you must own it. And what they said was that looking at the tea leaves of consumer demand, what they actually re-underwrote was that actually it's not that the price to earnings was cheap, it's that the E in PE was just wrong. And if they pass through all of these increases in inflation and, their earnings expectations into Facebook, it's actually more like fair value at a lower price. That's why they sold it so much on a day where the market was up. Now, why is that important? Well, eventually you're going to touch all these other stocks as well that are going to go through earnings revisions in this recession. This is where I think Wall Street has done a very poor job on behalf of retail. If you look at the average estimates of earnings, you will be shocked to hear that Wall Street actually has this year being record earnings, next year earnings continuing to go up. How is that even possible? How do you see earnings continuing to go up into these prints like this when you cannot pass through 80, 90% increases in energy and COGS and whatnot? You have to sell fewer things because there'll be fewer people with jobs to buy things. I think Wall Street's wrong. And I think that earnings are going to go down this year and will definitely go down in 23. And so I think what probably happens is the entire world of equities needs to get repriced at a lower price. And in that, it's going to put enormous pressure on these cash-burning, non-profitable tech companies. Part of the government acknowledges that you have to really ring-fence and protect consumers. If you look at the securities laws, they're meant to protect them at all costs. But the reason is because sometimes you want people to make good decisions. And if you give them a bunch of firepower, they're just going to spend it. And what we really did was we gave folks just a ton of money. And what did they do? They acted rationally. They spent it. Now we have to take it all back. I don't think that's going to be as easy or as simple as people think. It's stunning that, the reason the stock market went up, dollar for dollar, was actually tied to the growth in the M2 money supply. The correlation was 0.92. So for every dollar that the Fed printed, the stock market went up by 92 cents. So it stands to reason that if the Fed is going to take $3 to $5 trillion of value out, then we have to re-rate the equity markets by $3 to $5 trillion at a minimum. And then you have to re-rate and re-baseline for earnings. And so that's probably another 20 or 30%. You're assuming that all of a sudden demand is stable, but it's not necessarily stable. In a demand contraction, yes, people get fired, but then also new job openings change. There's fewer of them. They're more specific. Again, we're at the beginning of the beginning. For all of us that lived through 2000, this was 4 years of sheer hell and a grind. Now we have $30 trillion that we have to work through the economy, a recession we have to overcome, a war we need to end, and people all of a sudden assume that 2 or 3 rate hikes and 5 or 6 months of headlines are enough. And on the margin, maybe they're right. But from my perspective, it's an observation that we're at the beginning of something that just fundamentally has to take some amount of time to work its way through the system. And so I don't understand why anybody would give up their liquidity in this moment right now. Why would you? Why would I give up $100 million of cash in my bank account? I would not do that right now.
The people in Russia are suffering during this. The people in Ukraine are being murdered. I mean, how does it end?
The problem is that Biden engaged the United States in a proxy war without our real explicit discussion, number one. And then number two is then we pulled and we pressured Europe to really draw a hard line, but then now are kind of working around it so that the countries that suffer the most are Europe. Now, I think you're starting to see the tea leaves, though. Last week, there was a group of European leaders, I think it was Macron, Draghi, and one other person, who went to Ukraine. And if I had to bet, I think the message was we need to find an organized detente here, because there is, according to Europe, a Lehman-like situation in terms of economic contagion that could manifest over the next months. So I think that the end game is probably some organized, negotiated detente and ceasefire. I don't think anybody will be happy with it, but I think by and large, Russia is and has won, meaning they've won economically. They're selling oil like it's not going out of style. It's just not selling it to Europe and to America. They're selling it to China. They're selling it to Africa. They're selling it to India. We engaged in economic sanctions, and I was the first one to say, hey, this could really work, and this could be a roadmap for how to do it. And it turned out this is the roadmap for how not to do it. You can't, on the front door, say, here are these sanctions, and then walk around the back door and basically open the door for them. These sanctions were so porous as to be like Swiss cheese. We focused on virtue signaling acts, confiscating a plane or a boat or a house, but we didn't focus on the structural things we needed to actually make the mandate that we believe to be just to come to life. And so Russia's completely worked around it. Their economy effectively is thriving. So what have we gained? It was the exact opposite of what we tried to do. Russia's current account surplus more than tripled in the first 4 months of the year. Prices surged for oil and gas imports, and imports plunged under the weight of sanctions. Well, if you're Putin and you're looking at this, you're like, wow, maybe I should be under sanctions more often. What country should I invade next? So not only did our sanctions package not work, and not only is the Treasury flailing around now trying to find even more backdoors, we actually opened a very dangerous precedent, which is now we allowed oil to settle in currencies that are not just the United States dollar. And now Russia and China are trading and settling in CNY. That's not good for us. This is not how you preserve the reserve currency of America. If you have a country that has existed in some way, shape, or form, the borders could be blurry, but roughly, for hundreds and hundreds of years, and in some cases thousands of years, where internally the population of that country views themselves, in a great way. They don't feel like their country is a meaningless nothing country. Any attempt to economically humiliate such a country tends to have failed in the past and will continue to fail. And there tends to be other countries who view it as one of these things where, well, if them, then why not us? And then they sort of, in a backhanded way, support everybody. So we end up in this odd situation where we are picking fights we cannot win. And the consequences for us are economically really damaging. And then the
Absolutely.
consequences for everybody else to stay on the sidelines is like economic prosperity. That doesn't make any sense.